Hi, I'm Wayne Connors, founder of Retirement Investor. Welcome to this month's investment update ending December 2014. In this commentary, we're going to review the year-to-date performance of financial markets, the retirement investor model portfolios, and the funds within the model portfolios. But first, let's take a look back at the year 2014. I'll never forget the news headlines at the end of 2008 during the U.S. financial crisis that read, "The days of 10% returns in the stock market are over." Well, 2014 marked the 6th year in a row that the U.S. stock market has risen, and instead of annual returns of 10%, the market has averaged nearly 22% annualized returns over the last 6 years from its low of March 2009. Unfortunately, many investors never got a chance to receive those returns because they failed to stay invested, and 2014 was no exception. The year started off with the S&P 500 index dropping 3.5% in January, and the Dow Jones Industrials dropping over 5%. And after 5 years of positive market returns, many investors were easily persuaded that stocks were dangerously overvalued and due for a correction, meaning a decline of 10% or more. The Wall Street Journal warned in January that the U.S. stock market was overvalued. Money Magazine even chimed in by saying stock prices are among the frothiest in history. And then in October of this year, the New York Times stated the party's over. However, patient investors with discipline were rewarded, as by the end of 2014, the U.S. stock market hit a record high on December 28th, and the Dow Jones Industrial Average shot past the 18,000 milestone for the first time. In the end, the U.S. stock market, as measured by the S&P 500 index, surprised investors in 2014 with an above-average return of over 13.5%. Stock returns in foreign markets were mostly positive in their local currency. Among 45 developed and emerging markets, 35 had positive returns, and 17 actually had higher returns than the U.S. However, because the value of foreign currencies declined relative to a strong U.S. dollar, the net result for U.S. investors was negative, as international developed markets finished the year down nearly 4.5%, and emerging markets declined nearly 2%. This is a good time to mention that with U.S. stocks flying high compared to foreign stocks, now may be a good time to examine your investment portfolio and rebalance your asset allocation to reduce risk. Your allocation to U.S. stocks may be overweighted, and with valuations in foreign stocks significantly lower, rebalancing your portfolio will mean you would be selling high and buying low, which is a recipe for higher returns long term. And lastly, the broad U.S. bond market continued to advance in December, bringing its year-to-date return to nearly 6%. Once again, this is another area where market commentators got it wrong, as the majority predicted that interest rates would rise in 2014, causing bond prices to collapse. Instead, interest rates continued to decline throughout the year, causing bond prices to rise. Next, we're going to take a look at how the model portfolios at Retirement Investor performed year-to-date ending December 2014. Periodically, we like to see how the performance of our model portfolios compare to actively managed mutual funds that also invest globally. We're proud to mention that in 2014, our model portfolios outperformed 98% of all mutual funds in Morningstar that fall into the category of world allocation, meaning that they asset allocate globally similar to our model portfolios at Retirement Investor. Part of the reason behind our outperformance in our models is that we use low-cost index funds in the form of ETFs, which stands for exchange-traded funds, as opposed to our models using actively managed mutual funds, which carry higher fund expenses and don't diversify as broadly because the manager of the fund is trying to pick winning stocks, which can be a recipe for disaster. Index funds were hard to beat in 2014, and with the continued growth of ETFs and index fund investing in general, actively managed mutual funds are feeling the pain. In 2014, $78 billion went into actively managed mutual funds, while smarter investors poured $347 billion into index funds. The model portfolios at Retirement Investor show you how to build a strategic asset allocation using a thoughtful combination of 10 low-cost index funds using exchange-traded funds, also called ETFs, that when combined offer you diversification across 10,000 companies covering 45 countries. We offer a model portfolio for every investor's risk level, whether it's the conservative portfolio with 20% stocks or the aggressive portfolio with 80% stocks. You get the same high level of diversification in each model portfolio. The conservative portfolio holding 20% stocks and 80% bonds, returned 7.1% in 2014. The conservative moderate portfolio, holding 40% stocks, returned 7.9%. The moderate portfolio, holding 60% stocks, returned 8.7%. The aggressive portfolio, holding 80% stocks, returned 9.5%. And the total equity portfolio, holding 100% stocks, returned 10.3% for the year, even though it held funds in foreign markets that had negative returns in 2014. Next, let's take a look at the performance of the funds within the model portfolios by asset class to see what contributed to the model portfolio's performance. Our S&P 500 index fund, representing U.S. large companies, returned 13.5% for the year and actually outperformed 83% of all actively managed U.S. large cap mutual funds. Not far behind was large cap value, which returned 13.2%, followed by mid cap value, which actually outperformed the S&P 500 by returning 14%, and small cap value, which outperformed all other stock funds in our models during December, rising nearly 2%, returned 10.6% for the year. Looking overseas at international developed markets and emerging markets, international large cap companies continued to decline in December and returned negative 6.3% for the year, while international small cap companies dropped 6% in 2014. Emerging markets also experienced declines. However, it was emerging market large caps that dropped more than emerging market small caps, both returning negative 3.4% and negative 2.7% respectively. It's important to note that these asset classes still offer significant diversification benefits in your portfolio, as I've seen them have a negative year and then the very next year rise as much as 98%. REITs, representing real estate stocks, continued to rise in December and finished the year with a return of nearly 32%. I'd also like to remind you that this asset class returned only 1.5% the year before. And lastly, our broad U.S. bond market fund, which seeks to track the performance of the total U.S. bond market, returned 6.3% in 2014 and outperformed 73% of actively managed bond funds, according to Morningstar Research. So looking ahead, what's our thoughts on the future positioning of the model portfolios and whether any changes are expected? Although the U.S. continues to exhibit the strongest economic growth globally, we plan to increase our model's allocation to foreign stocks, both in developed and emerging markets, since the stock markets of these countries are currently 20% to 40% undervalued compared to the U.S. stock market. However, we expect that the U.S. dollar will remain strong against foreign currencies, so we'll be adding an international index fund that not only diversifies across several international markets, but will also protect the model portfolios by hedging against a decline in the value of foreign currencies. We plan to slightly increase our allocation to REITs, as this asset class provides a higher yield than bonds and is attractive to investors in the current low interest rate environment. And lastly, we will be maintaining our bond position, which diversifies across the entire U.S. bond market. We expect to make these changes to the models at the beginning of February, and all subscribers to Retirement Investor will be notified by email, so they can visit our website and use the Update My Portfolio tool to print out the changes, and then make the trades with the online broker of their choice. So, until next month, stay invested, stay disciplined, and make the markets work for you.